Welcome to Talking Tuesday. I am your host, Fancy Quant, and today I'd like to welcome an amazing guest, Dr. David Shimko. He has a very diverse background here, as you'll see throughout our conversation around quantitative finance, specialization within valuations, experience across the board with risk management, commodities, as well as many other areas. He has also been a professor at University of Southern California, so USC, Harvard, and is currently working at NYU Tandon School of Engineering. So without further ado, let's dive on in. So David, why don't you tell us a little bit about, just starting off here with your educational background. What was your undergraduate degree, PhD, and how did you choose those degrees?
Wow. So my undergrad was in economics and kind of a minor in applied math. I went to Northwestern University. They didn't really have minors there. But I loved that school because it was close to my hometown in Cleveland, and it was kind of like the Harvard of the Midwest. It was my dream to go there ever since I was in high school. So I really had a great experience in Northwestern, so much so that I stayed there for my PhD. And I switched from economics into the business school and studied, at the time it was called managerial economics, but it was really a game theory department.
Okay.
There were people there like, some people that subsequently won Nobel Prizes, like Roger Myerson was my professor there, just won a few years back. It's just some really path-breaking stuff in game theory, which I was fascinated by, but I thought it was so mathematical, it wasn't applied enough for me. So I took an elective in finance, in option pricing of all things. I think the professor was Ravi Jagannathan, who I still stay in touch with. And I said, wow, this is really practical. I love this, and it kind of fit really well with what I was doing in economics. It fit my research interests. I worked with Dan Siegel. I worked with Robert McDonald as my chairman, and they were a great inspiration to me. And I thank them to the day because of the advice they gave me was really great.
Okay. Did you look outside of Northwestern? So I know a lot of students ask me, and I tell them I don't know, academia has this weird look where it's like if you go to the same undergrad and the same PhD, you kind of have the same train of thought. But I guess in your scenario, you kind of switched schools as well. It wasn't like you were taking finance and then finance.
That's exactly it. In fact, when I was finishing my undergrad, I had an invitation from a math professor to pursue a PhD in math. And I didn't want to do that for the same reasons, that you just mentioned.
Mm-hmm.
But the fact that I was going into the business school, it was a faculty with which I was completely unfamiliar. I thought that the experience could be as different as going somewhere else.
Okay.
And so for exactly the same reason you surmised, that's why I felt I was able to stay at Northwestern.
Okay. And what was your PhD thesis on?
So I was applying, at the time I was doing option pricing theory exclusively, and I applied option pricing to the pricing of insurance contracts.
Okay.
Because if you look at a call option, the call option you exercise and it's in the payoff function, right? It's a truncated payoff. Exactly the same thing you'd have like with an insurance contract. When you have a loss in an automobile crash, you pay the deductible and the insurance company pays the rest.
Mm-hmm.
But the difference is you can have a crash every year or several crashes a year. And so what I basically worked out was kind of a time integral of Black and Scholes option pricing.
Okay.
So it took me a couple of years to do it, but it actually turned out to be right. Peter Carr came back. He thought I had it wrong, but he worked it out. He said, damn, you got it right. That was our relationship from the beginning, was, trying to make sure we had it right.
So how did you meet Peter Carr? Because I know you guys have known each other for a long time.
That wasn't until I took my first job at USC. I was teaching there, and so I was a first year rookie, and he was like maybe a third or fourth year graduate student at UCLA.
Okay.
And I love to travel across town from downtown to the West Side to go to those finance seminars with all these, guys like Richard Roll and Longstaff and Schwartz. And everyone was there at the time. I felt like, wow, these are like, this is a place where all the stars are. And I love to attend their finance seminars, and they welcomed me to do that. So I got to know all the folks, but I really liked, there are a couple of guys I liked, especially, and Peter was one of them. That we got along with each other instantly, and really, had a lot of common interests.
Okay. Do you think these kind of groupings are still alive? It's kind of a weird thing. I know when I was talking to Peter before, he's talking about, giving this presentation, and he's like, in the front row, of course, is like Fisher Black and Robert Merton and like these just real Stephen Shreves, for example, these really big names. And yet, as we're kind of going through finance now, I feel like we're somewhat, I don't know if we're lost, but it seems like there's not as many pockets of academics, or maybe just because I'm so much on the industry side now, I don't see kind of the groups that are going on within the university systems.
Yeah. I mean, there are more and more places for people to work, which I think is partly contributing to this. One development, of course, was the separation of financial engineering from finance, you
Mm-hmm.
know? So finance as practice in business schools, I would have to say that financial engineers were never really that popular.
Okay.
Even at the time, people thought, Black-Scholes Merton, great, they did a fantastic job. But what are all these other mathematicians doing that are coming into the field and publishing these papers that few people really understood the technical details of in many cases? That could have been, improvements from a financial engineering perspective that weren't considered really material from a finance perspective.
Okay.
So I think that's part of it is the sort of the foremost split of the period of the people, which at that time, was they were really combined, and you'd have like, a token financial engineer in every department, and we'd all have the same problems. Very hard to publish in Journal of Finance or Journal of Financial Economics at the time, because a lot more people were doing very robust kind of statistical, wide-ranging work. The whole information theory was getting to be very popular, and financial engineering was becoming less popular. So we
Okay.
don't have this pocket, as you say, and part of it is that these people they got picked off. That department at UCLA, there was so much demand for those people, not only at schools, but because this is finance, so much demand in industry for this talent. So someone could go to industry and make a $500,000, as a starting salary. You can't blame them for leaving the academic scene to take advantage and to apply their skills in a on a bigger blackboard, as it were.
Yeah, definitely. Do you think it's becoming better now? Like there's more acceptance of financial engineers in the industry,
I
or do you
think
think it's still about the same from what it was?
I think what happens is we've each found our niche, right? There are people who like financial engineers, and those tend to be the trade people, right? The industry people who value these sort of tangible advances that help them be better traders or better asset managers or valuation specialists or whatever. But the traditional finance people are kind of going in their own direction and building their own fan base. And so the students pick where they want to go, and now it's very much a separate thing. And these academics go in different directions as well, and they both seem to be happy in their groups. Me
Okay.
personally, I think that we've gone a little bit too much toward the math side. Again, this goes back to my training as an economist, but that maybe in some cases we've lost the intuition and the application, because of the rigor of the work that's been done in financial engineering. That frustrates me sometimes, that I wish we had more financial content in our work.
Do you think part of the problem is coming to the fact that quants now, so financial engineers, are being expected to do everything? I think often, so many people know I review a lot of the master's programs in quantitative finance. And one of my big complaints is one, they're shortening them from 2 years to a year or a year and a half. But we still have this issue where it's like when you join the firm, you're expected to know the financial side, which I do find a lot of students just lack the basic fundamental theories of finance. And then on
Yeah,
top of that, you're required to know the mathematics and the, computer science to implement it. And then plus the statistics and the economics all coming into one thing. Like I find it's almost impossible to find someone who has that full spectrum of all the skills put together.
you're absolutely right. And what happens is people separate into their categories. We have people that focus on machine learning with just the minimum amount of, finance and risk management. And then some people who focus on risk management only, and only get the computing skills or, other finance skills that they need on the way. So I see our program, for example, we have something like 150 students a year, right, coming into the program. And so they've got to split into different specializations.
Yeah.
They're not going to be able to do it all. We're not going to cut the program length, you know.
Yeah.
We're going to allow them to develop as much as they can within their particular area. So we have something like 4 different tracks within master's degree in financial engineering.
Do you guys feel like you're competing though with the finance side of it?
I wouldn't say that. People who want to go pure finance have different objectives. Some of them want to go more to an MBA or an MA program because they want to be in that hiring pool.
Okay.
people who want, financial economists, right?
Hmm.
And there are people that do that. But I would say in terms of numbers, I mean, how many of those people are going to get hired compared to the people that actually do, right? The computing, the analytics, the reporting, all the work that engineers do these days in banks and financial institutions.
Yeah, I can see that. I mean, so you have a textbook that you're working on, and I've been
Mm,
reading some of your rough draft on that. And one of the pieces is kind of this conversation that strikes me at the beginning, which is you're trying to define financial engineering,
yeah,
which nobody wants to do. I've done it on YouTube and people complain on all sides of it. But I think it hits on this point of, how do we bring finance either together, or how do you segment it into like this is more of a traditional finance path, and then this is more of a financial engineering finance path? And I
yeah.
think, and what's the purpose of your book? Because it seems like you're taking a really interesting approach where you're taking the financial theory side, so much more of a finance perspective, but then trying to apply the rigor and more of the modeling aspect to that.
Right. So if you think about finance theory, like when it comes to evaluation, and first of all, to begin the conversation, I would say evaluation is the foundation of everything in finance,
Mhm.
right? Net present value is a evaluation, right?
Right.
Um, Capital structure in a corporation is a valuation. What's the capital structure that maximizes the value of my firm, right?
Right.
Dividend policy is a valuation. What's the dividend policy that maximizes the value of my firm? I tell my students they can get 1 point on the final if they say the objective is to maximize the value of the firm. But the point is, now you dig into the deeper side of this. Say, okay, valuation. What are the tools I have for valuation? What I have is if you open any finance textbook these days, you see the same thing you saw in the 80s or 90s. There might be updated stories and so on, but there's going to be the same fundamental theories of valuation, which are horribly flawed. And I think I wouldn't have been aware of it unless I had done a stint in consulting to see working for energy companies that these models just don't work.
Right.
So I can give you like a couple of very simple examples. You're working on a power plant supply contract, right? And you don't know. You have operational risks that you don't know if you're actually going to be able to deliver power or not. Maybe there's transmission constraints or system shutdown, something like this. There's price markers like in terms of electricity and natural gas you can follow. The expected value of the contract is positive.
Okay.
What's the net present value? Now, doesn't matter in the CAPM what discount rate you use. The present value will always be positive if the expected value is positive.
Right.
Now, when you see that there's a bid for these contracts and some of the bids come in negative,
Okay.
and you say, why is that? The answer is the risk is so big, right? It's being taken by institutions that have operating and financial constraints, so much so that they have to charge for the risk that they're taking.
Hmm.
And the charges for the risk exceed the otherwise would be the present value of the project. So we have nothing in that theory of finance that deals with negative valuations when expected values are positive. Nothing.
Okay.
So you're hired as an engineer into an electric company to value their contracts. And you say, let's use the CAPM to value this thing. You're going to be fired in a week.
Yeah.
And this was the core of my consulting practice for over 20 years, was advising energy companies on how to value these contracts with models that would, A, allow the values to go negative.
Hmm.
B, they would be real multi-period models, which means the cash flows are going to be correlated from one period to the next, where the CAPM doesn't allow that.
Right.
So now you ask, what does a financial engineer do? You start with the theory, which is what you have is the CAPM, right?
Hmm.
And then you say, how do I apply it to valuing these electric contracts? And you screw up. You can't do it. The tools
Okay.
are not there. So I started when I was a consultant, I started to fix this. I started to come up with new valuation models. And every time I have to say, every time I discovered something, I found some obscure reference in the finance literature. But
Okay.
something
Yeah.
that hadn't been developed into the pedagogy.
Hmm.
So I went back to the CAPM. It turns out the Sharpe's CAPM forecloses a lot of analysis by making one assumption. And the assumption is expected returns and standard deviations are constant and known.
Right.
Once you do that, you foreclose the basis for those parameters. You can't determine what those bases are. So I actually had to go back to the earlier version of linear CAPM and work out new tools for doing evaluations that allow for, the possibility of negative valuations. And every time I did this, the multi-factor CAPM had to go from linear to, another paper by Stapleton and Subramanian, which is where I started. And I said, okay, now what does the financial engineer do? They need to have a richer valuation model to start with, right? And then they need to learn how to apply the theory that they learn into the valuation of this particular contract, because that's their job.
Right.
So just like a chemical engineer takes theory of chemistry and applies it to solving a problem, right, in a chemical plant. So a financial engineer should go to a bank or a hedge fund or whatever, take financial theory and apply it to solving an important problem there. So that's what my book is about. It's about valuation. It's not for MBAs looking to benchmark and find betas and all the stuff they do, right?
Yeah.
It's to say, here's a richer class of models I'm going to give you, which are consistent with financial theory. And here's a set of applications. So in the third week of my class, for example, students are valuing CDOs, collateralized debt obligations. And people say, what are you, crazy? In the third week, you're talking about CDOs? I say, yeah, I am crazy. That's really a separate point. But the thing is that the CDO, right, what is that? You take this asset, which generates cash flows, you divide it among the different tranches with claims against the asset. Isn't corporate finance the same thing?
Yeah.
Right? You take the asset, which is the corporation, it generates cash flows. The cash flows get distributed to the government, to the debt holders, to lawyers, to the consultants, hopefully, and eventually to the equity holders, get the residual.
Right.
So the residual in the CDO tranche structure would be the same thing as the equity in a corporation. So then it makes it very natural for them. If they have the tools to do bond valuation, then they can do CDO valuation, then they can do corporate valuations.
Okay.
Right, and that's kind of a theme of the book. But then you throw in the fact you have all these other benchmarks, which are, if I'm going to value an oil company, I see oil futures prices. Shouldn't that have an impact on the value? Right? I see option prices. Shouldn't that have some impact on not only the valuation, but the risk assessment as well?
Right.
So how do I integrate this all into one valuation framework to give the engineers all the tools, at least the tools that I could imagine and have used, to solve different problems. Thankfully, not all at once, but in different applications. Give them all the tools that I've had experience with as a consultant that were derived from theory and applied in practice. And so by the time they get through the course, they realize that this is a completely different approach to evaluation, but it's one approach that subsumes everything else.
Right. Yeah. And you've come up with this perspective now of being able to teach, I guess, option pricing from the perspective of CAPM in discrete time. Is that what
That's right. Yeah. This is I was really proud of this, and something that Peter helped me a lot on with that one day we met in his office. But the idea there was that, people in the past have tried to use the CAPM to price options. Okay. Now you remember the CAPM assumptions. You have n independent assets. You have a full rank covariance matrix, and so on. Right. So in the CAPM, there's no arbitrage possible because there's always residual risk.
Right.
Right. So it's not necessary to make any adjustments for preventing arbitrage. So if you use the CAPM as it was designed, and you try to calculate an option price using the CAPM, there were two papers that discovered that this is impossible to reconcile the two because of the nonlinear risk profile of the options compared to the linear profile of the assets in the CAPM. You couldn't reconcile them. And in fact, it was so bad you would get negative option prices and you would get non-convex option prices. I know you have a pretty technical audience, but that means that butterfly spreads would have negative prices and have a positive payout guaranteed.
Okay.
Right? So basically, when I looked at this, I said, why don't we say instead, I was trying to find a way to teach the CAPM to students without using options to students without using stochastic calculus. So we just done a chapter on the CAPM, right? How do I do options? I said, what if I incorporated a no arbitrage constraint in the CAPM derivation and recomputed the equilibrium?
Mm-hmm.
And if you do that, if you put a constraint that says, hey, option prices have to be convex in the stock price, right?
Okay.
Put that constraint in, rerun your program, what do you call it? Nonlinear program, if you will. It's not a program, it's an analysis. But you get a closed form solution, which says the only way this works is if you have the mean of the distribution of the assumed underlying asset maturity is equal to its forward value.
Okay.
So it's the risk neutral pricing concept, but it's proved in a simple CAPM framework. So you add the constraint, you re-optimize the CAPM with the constraint, and you're able to price options because what it does is it converts everything to risk neutral equivalence automatically. Okay. And according to the linear version of the CAPM, that's exactly what you're doing anyway, because instead of taking like the sharp version, you take the expected value, discounted at some rate. The linear version, you subtract a risk charge, right? And then discount at the risk-free rate.
Okay. Okay.
So because of that, you end up converting everything to risk neutral pricing, and all the option pricing works. So the great thing about this from my point of view is I get a lot of these master's students who are 22 years old, right? They're just out of undergraduate school. And here I can now teach them option pricing with only college level calculus.
Okay. Which is very helpful because I think one of the biggest stumbling blocks for quantitative finance students is the stochastic calculus piece. Like even people talk to in the industry that went through the same programs, they're like, oh, those classes in stochastic calculus and option pricing were the worst. They're like, they were super interesting, but they were just really hard to grasp, especially if you don't have a lot of fundamental math courses behind that, like real analysis, which is building on your probability theory, which is like this big layering. So do you think this is I guess I view this more of like a fundamental kind of break in the industry here where we're seeing you can actually price this more from a financial perspective, which one allows more people to understand it. But I think more importantly, you actually are coming at this from a traditional financial theory perspective, which helps kind of well-round and expand the view of the finance community.
Yeah, I think it's a really nice way to put it. I mean, I see my role as like finance has charged forward, right, since 1960, right, on its trajectory. And it seems like we've taken the science to be kind of proof science as we go, right? And maybe because I was out of academics for 25 years, when I came back to it, I was kind of mentally in the same place I was 25 years before. So it's kind of easy for me to step back into that role and be critical of, right, like time travel, right? Yeah. You can be critical of the model. You wish you knew that when you're in your 30s, right? But you don't find out until your 50s, and you've got to go back and say, hey, someone made a assumption that the stochastic discount factor had to be a positive number.
Yeah.
And when they did that, wow, they completely changed the direction. And that gave us these ridiculous valuations.
Yeah.
Do
you think there's a piece of us though that needs to go back from a math perspective now and re-challenge all the assumptions from traditional finance? Because even like the Black-Scholes is genius. Like I think this is one of the best things for my master's was you start off with the Black-Scholes, you learn it's simple, you learn it's dumb, and it doesn't work, and it's the worst thing you've ever seen. And then you go through all this numerical analysis, and you realize at the end of the day, it's this huge effort of, struggling with the Black-Scholes to come back to realize it's a beautiful formula and it has great assumptions. But often we're going to have to kind of pull those assumptions apart and break out, more complex solutions here. And I think in many ways, that's what you've done with the CAPM is now you're kind of backing out some of those assumptions and looking at how do we restructure this from a new framework.
It's I think your characterization is accurate. We do need to re-examine these things, but I find it interesting that you say great assumptions. Okay. Because if I think about, I like to look at equity options, and although I'm a commodity guy, when I trade options, I mostly trade equity options. Okay. I don't have the stomach to trade commodity options. But those great assumptions, right? You take a log normal distribution, right? That's positively skewed.
Hmm.
Do you think equity prices are positively skewed?
Yeah,
Really? Because
a
that
little
means
bit.
that if I wake you up one morning, you say the market has moved 20%. Do you think it's moved 20% up or 20% down?
That's challenge. I mean, if it's in one day, I would assume it went down.
Exactly.
I do think so.
So returns are negatively skewed, right?
Yeah. Well, yeah. I think part of the problem though with a lot like the Black-Scholes is a framework is it makes a lot of really good assumptions for really well-behaved stocks. But when you look at now in our modern crazy time of technology, like Tesla stock or Twitter stock, we see it shoot up even in randomly. And it's like, somebody makes a statement like Dimitri Bianco, I don't know, tweeted out, you should buy Tesla. And then all of a sudden, like 40% of people are buying this stock and it's just being driven by crazy patterns.
I see what you mean. Certainly at the individual stock level, you can argue what the distribution is. But
Right.
if I had said like the S&P 500, I think you would have agreed it's negatively skewed,
Yeah.
right? So next point is go back to individual stocks. With a log normal distribution, the price can never actually reach zero,
Correct.
right? So low price stocks can't go negative. They can't go to zero even, right? We know they can't go negative because of limited liability, but they can't go to zero, which means that we're going to have a pricing bias for low priced stocks.
Right.
The third point I'm going to make is that kurtosis is off. There's not enough kurtosis. Those tails in a log normal distribution are too thin.
Mm-hmm.
And finally, the centerpiece of this whole thing. I had so many discussions with academics where they say, well, the arbitrage approach of Black and Scholes is superior to the equilibrium approach of the CAPM.
Okay.
And I say, sorry, I disagree with you. And they say, what are you, friggin' stupid? Arbitrage is better than equilibrium, don't you know? I say, well, it's not really arbitrage, right, Black and Scholes, because it's arbitrage under the assumption of no transaction costs,
Mm-hmm.
right, and infinite ability to trade, right, at any frequency.
Right.
You add the smallest transaction cost to the smallest delay, and those models fail like crazy.
Right. And I think
You
that's
know?
the assumption piece, though. Under the assumptions, it's great.
Okay.
But when you have to take out, I mean, this is the whole premise, I think, what a financial engineering master should do, which is it should teach you the fundamentals from a business perspective. And then you should learn how you have to take out all these assumptions. Because you're right, when you start to adjust them for the real world, like volatility is, not constant across time. When we start to tinker with these models, you have to get into more complex methods to make somewhat corrections to it. And then
Right.
things really blow up in complexity.
But here's the problem is that the base of all those explorations is the Black-Scholes model,
Right. Yeah, we're
right?
starting with
So
an assumption up front.
you're struggling with the negatively skewed implied volatility, which is a nightmare, right, from a modeling perspective, because it's supposed to be a constant volatility. So what does implied volatility even mean, right? And you construct these vol services based off of this flawed model,
Mm-hmm.
And I know there's lots of great approaches for dealing with this, but they're so, right, complex. Why not fix the model in the first place? Why even have the same distributional assumptions for every market? You think Black-Scholes applies the same to commodities or to equities or to rates? No way.
No.
Right. So I would say where you were headed in the beginning, I like that because I could say to my students, let's start with the distributional assumptions. What do you want those probability distributions to look like? The method I described to you works for any probability distribution, a reasonable one, like a compact support and so on,
Yeah.
with finite variance. So those distributions, all I can show that risk neutral pricing applies. The Black-Scholes pricing formula itself, also, again, I'm a history buff in options, Black-Scholes was nearly discovered, several times before 1973.
Mm-hmm.
Right? And what these guys did, the formula looks so complex, but if you know already what the formula is for the truncated log normal distribution, the expected value of that, you've already got the whole solution except for the discount rates.
Right.
So all of Black and Scholes is about, in my opinion, and why they won the Nobel Prize is not because of the form of that function, but because of the discovery of risk neutrality in this context.
Okay.
Right? that they were able to do it to solve a problem that no one else had satisfactorily solved, except for one person. That was Bachelier in 1900.
Yeah.
Now people say, "Oh, his model was ridiculous because it's a normally distributed underlying. That means that the thing could be negative, right?" But compared to the other biases of a log normal, I'm willing to forgive him that, and you'll see why in a second, right? But he's because he used the forward prices of the underlying as the root of the distribution, the base of the distribution. He actually had risk neutrality built in.
Yeah.
So he had the correct answer for that problem.
Okay. So it just wasn't the explanation of that risk explicitly that is what made the Black-Scholes
Right. That's
so
right.
different.
Yeah. So, when I say I like to go back in finance, I really like to go back. I know the option history from the 1950s. I know Bachelier inside and out. And it was really helpful to have that background to work on this book, because then when I ran into problems, and that's really what happened is you try to write a book, it's difficult, right, all the time. But you start with some idea, right? And you're going to, let's see, you start with your class notes, right? And then you start to work it into a textbook, and you start to find a consistent theory, and then you find something that just hits you in the face, like a roadblock.
Yeah.
And this is one of those roadblocks. Here I am trying to write this accessible book on finance theory for financial engineers, and I hit this stochastic calculus roadblock. Can I get around it? It turns out I could, and it became a paper. The other problem I deal with is consistently is what happens when you take the CAPM and you apply it to multiple periods. There's lots of theoretical papers on this, but in practice, right, people just apply the same discount rate over many periods, or maybe they might shift it once for different ages of a company or something like this.
Yeah.
But if you're really going to do a good job of multi-period valuation, you have to consider intertemporal correlations, which is something that Fisher Black was harping on a long time ago, but no one ever really took it seriously. And it turns out that's really important, because if you're going to take a time series of cash flows and try to value them, right, in a real world context, you find there's lots of persistence in cash flows.
Yeah.
So if a company's successful, it's going to tend to have high cash flows for a while. If a company fails, it's going to tend to have low cash flows for a while. So that's not indifferent, as the CAPM application would suggest. It's extremely important, because that persistence is the same thing that is reflected in high correlations of the cash flows from one period to the next, which means you have risk concentrations in the cash flows, which means you have lower valuations.
Right.
So the CAPM is going to tend to, right? It's going to tend to overvalue these kinds of companies with persistent cash flows.
Okay.
Right? So how do you fix that, right? And so on the street, what you do is you raise the discount rate.
Yeah. Yeah.
Right. And what I'm saying here is that maybe that's not the right approach. Maybe instead, think of a true multi-period model that considers these correlations. And when you simulate those cash flows and you have high following high and low following low, that ends up being part of the valuation.
Okay.
So that's another tool that my engineers will study, is how to do multi-period valuations, allowing for correlations and changing risk over time.
Do you ever see making a sequel to the book, a more mathematical driven approach? I saw in your simulations chapter you focused on simulation from the aspect of normal and uniform distributions. But often when we're in industry, I'm building out non-parametric forms and then pulling off of these. Or do you think that's more of like a post class, like somebody else is teaching a mathematics class on like Monte Carlo simulations, and then the students can obviously connect the dots of like, this is extremely valuable for valuations, and we learned normal and uniform distributions, and then we can apply another layer of complexity on top of that if the scenario requires it.
Yeah, I mean, this is like, it sounds like one of my final exam questions, right? Is you learn how to do this for the for the exponential distribution, now do it for an empirical distribution, because they should be able to just plug that in and say, okay, I can invert the cumulative right frequency distribution from historical data and use that as my random number generator.
Right.
Right. So they should be able to do something like that. As for me, if I write a sequel, I don't think it's going to be more mathematical. It's not my strength, right? I'm an applied math person. I know enough math to be dangerous, maybe, on my best days. But I'm not going to go and do a more theoretical text. But what I'm thinking about doing, if I get a long rest in between, is to do something, maybe a book specialized in corporate finance, or a book specialized in corporate risk management.
Okay.
Applying these tools to those problems.
I would have absolutely loved it if you would have had these books, I don't know, 15 years ago when I started. Because I come from I have a finance degree. I went into finance. And then I realized you can't work on Wall Street and actually value things out without math.
Yeah.
So I abandoned my finance background, went into financial engineering and applied economics for my master's, and then came out with a bunch of math. But then I guess, probably more similar to you in the sense of like, I'm starting to view things in a corporate finance space because I worked in corporate finance for about 8 years. And then I have the traditional finance training, and then I have the economics training. And then shifting into that pure math, it's hard to make that transition. Because for me, I'm kind of thinking like, how do I tie this back to financial theory to make sure that I'm not just, this is a number, I modeled the number, but what does that mean and how did we get to there?
Yeah. I mean, I like the financial theory, and I don't want you to misconstrue the next statement, but when I was a graduate student, I was always suspicious.
Mm-hmm.
Why do we use utility functions to value assets when I don't even know what my utility function is?
Right. So I deviate probably from all of quantitative finance in this realm. I view utility functions as a necessity. So Peter disagreed with me on this heavily too. We had a discussion after our interview. And I view utility functions as the unknown that we can't model. So I agree with you on that. But I view that as the driving risk behind the change in valuations. So when we see companies shift and some company comes up with a ridiculous product, and I'm super conservative, so I look at some new technology like Chat GPT, and I'm like, this is dumb. It's just new technology. It'll kind of, equalize out. But I think the shift in a lot of the utilities of what makes people happy is that risky piece behind the scenes that we will never model. And you're right, there's no way to model it because I have no idea I can't even make an equation on, Dimitri's happiness or utility function is equal to, and then add up a million things. Yeah. But at the same time, I think from a theoretical perspective, it's good to think about these and say, okay, my model is not perfect. And I think one of the driving forces behind that is the utilities are always changing for individuals, and we'll never actually know the driving piece of that.
Yeah, you're right. In my book, I don't talk about utility functions. I do maybe pay a little homage to them and say any utility function you write down is going to define what the risk measure is and what the cost of risk is. And in that sense, it's worthwhile, right?
Right.
But now suppose as an engineer, right, you'd probably be embarrassed to tell your friends you start with the utility function, right? Because you're probably going to start with the cost of risk because that's something you can actually measure.
Right.
Right. I can maybe not perfectly, but I can look at the historical risk premium on the S&P 500 and get some idea what the cost of risk ought to be if I consider my risk to be standard deviation. I could go redo that exercise and say, suppose I consider my measure of risk to be mean absolute deviation or worst case or whatever, right?
Right.
And given that flexibility, I can say, okay, I can design a utility function for you. Right? If you tell me the price of risk and the measure of risk, I can design the utility function for you. Right. And since I don't know what utility function it is, then what's the point of defining one in the first place?
Right. I'd agree with that. It's my concern though in quantitative finance is I feel like there's not enough thinking. There's a lot of these mathematicians where we just regurgitate the process, and kind of like you're saying, like, students should be able to look at that normal distribution, that uniform, and then draw the conclusion to use historicals. And I had an employee I was training a while back, and I'm having to explain to them, you don't need normal distributions to do Monte Carlo. And they were just adamant. Like in my class, I did normal. You have to have normal. It makes it balanced. And I'm like, it's just sampling. Like we could sample from anything in the world, but it's that, I don't know how you get students engaged to that point where it's like, I want them to get really excited about the concept and then try to drive further down the road with there's something unique within that framework.
Yeah. Well, the way I do it in the book is this through examples. So if we simulate cash flows, we're probably going to use a joint normal distribution with a full covariance matrix. So they're going to learn Cholesky decompositions. They're going to learn, all those tools. But then when we're doing bond modeling and we're going to model default, maybe I'll throw in a exponential distribution.
Okay. That's
Right.
good.
So they've got an exponential distribution for default, and they've got, cash flows, which are normally distributed, and they've got to correlate these two different things, right? Using a copula, because they can't use a, sort of regular, regular correlation, which assumes a linear relationship between the variables. So this is like by lecture 6, students are doing this. They're saying, okay, I've got two different distributions. I have to simulate values which are correlated in some sense, but I can't use the standard correlation to do it.
Okay.
I can't just run this through a Cholesky decomposition or whatever. I've got to come up with a way to simulate, exponential defaults and normally distributed cash flows.
Okay.
And so I figure by showing them a relatively simple example that illustrates the points, they can then build further examples. The more I go off into that theoretical trail, the more I'm going to leave behind me.
Okay.
Right? Who are going to say, we don't want to, we don't want to prove this in R infinity, or we don't want to prove this in complex plane. We don't want to, as a side, I've never had an interest in complex numbers because there was no way to code them in Excel.
Yeah.
You're not going to catch me doing Fourier transforms in my class, right? It's not going to happen.
Do you think one way to address, I guess, the possibilities of theoretical piece would be to bring in like industry practitioners for like a speaking series, just to kind of help connect the dots with students on, this is what you really need to focus on, but here's like a glimpse of what you possibly could do in the future?
Well, my whole dream is ultimately, is to create a YouTube channel. I know you know something about that. That would be focused on financial education.
Okay.
Like when my students take my class, I've done this in the past. I'm going to start doing it again. Normally, in the class you give a lecture and then you have homework or projects, right?
Mm-hmm.
So I'm getting tired of this because students aren't prepared enough for class and they can't solve problems. So I turn it upside down and say, okay, your homework is to watch the pre-recorded lecture.
Okay.
Come to class, I'm going to give you problems. And
Okay.
this is what Fisher Black used to do. He used to open his classes with 50 problems.
I did not know that.
For students to solve. You should read the not the autobiography, the biography of Fisher Black. Amazing story. He's a great man.
Yeah. So how do you get students involved in this? Because that's one of the problems I have now with ranking programs and talking to students and trying to make sure students are prepared for grad programs. There seems to be like the check the box mentality, which is kind of what you're talking about, right? You go to the lecture or you watch it online and then the homework comes in and everybody kind of just goes through the paces of, what did you do for problem 1? I kind of got this. Or now they're using online and just searching answers. And so I guess in a way you're combating that with that solution of let's do the class first as homework and then do the problems in the class.
Yeah. And where they're going to learn is when they solve the problems. So all my problem sets are actually called mini projects. And they're all kind of, how should I say, they're not completely specified problems, which bugs the what out of students. But let's say the mini project number 1 is to build a zero coupon bond term structure for bond prices.
Okay.
Okay. So as a professional in the field, this is a standard thing that a lot of finance people will be called on to do or need to understand because they're going to use the tools at their bank or their fund, right? But if you give students this kind of vague directive, to go and design a tool, it could be Excel spreadsheet, it could be a Python program. I don't really care. I care about the methodology used and what results you get, and show me how to do a bootstrap with a yield curve for zero coupon bonds. So we can price anything in the future we need because we need risk-free rates for everything. You need them for the CAPM, you need them for derivatives pricing, everything.
Mm-hmm.
So they go off and they complain that I haven't given them enough direction, but I make them do it in pairs, and I make them change their partner every week.
Okay.
So they also have to meet more people in the class and get familiar with working with people from different cultures than their own, because that's what Wall Street's like, right?
Yeah.
And they have to start getting used to the idea of building relationships because that's just important as your quantitative skills. So I like to think that I'm not perfectly there, and I'm certainly not trying to say I'm perfect in any way, but I'm struggling to make this class that kind of experience.
Yeah.
That this is somebody that sort of gets their attention and say, hey, not only is this material relevant, but this whole approach right to the finance profession is relevant to me, and I can be excited by that.
Okay.
And let's face it, some people never will be, right? They want to go do machine learning. They're taking my core class, which is required. They're going to do the minimum. They can see that as long as as long as they're not like at the very bottom of the curve, they're going to get a B, so they can be happy with that.
What are your thoughts on machine learning? I battle it constantly from an industry practitioner's perspective and from educational piece in the sense that I find students like to automate things, which I'm all for automation if it works. But
Yeah.
I often find that it's like there's no, again, going back to the theory piece, there's not a theoretical understanding of how do you know that works and how do you just not do it. And a lot, I think the master's programs are just chucking these like, everyone's using the same book. So I review all the books for the programs. They're all using
Yeah.
the same book, the same material. The professors have no industry perspective on this isn't going to work in practice because I can promise you it's overfitted. And it's just kind of this regurgitative process of like, let's just go through the math.
Yeah. Obviously, I have mixed feelings about it, and some of my consulting work is in the field of validating these commercial credit adjudication models.
Okay.
And some of these banks use machine learning techniques. Some use standard logistical regression techniques. And there's always this battle. What happens when you use machine learning, which is this black box? It kicks out a decision. It's hard to justify why someone didn't get credit, which is a problem, because there's not a linear relationship between a credit variable, and the decision. But on the other hand, you can identify relationships you didn't see before. In that particular business, there seems to be a balance drawn between what you use machine learning for and what you use, traditional techniques for. And to be fair, well, I'll tell you a story about one asset management firm I went to. I asked them this question about machine learning, and they said, "Oh yeah, we don't use any machine learning in our finance side at all. We use it for customer identification or prospect identification."
Okay.
So that was their solution: is use it where it works, which I think sounds like your criterion, right? If it works in this context, then go ahead and use it. But I guess the other thing we try to do is in our machine learning classes, we do strive to have these sort of statistical foundations of machine learning as well. So I like to think that we're attracting more people to the systematic study of statistics and inference from data with this hot new tool, machine learning, which a lot of people like to see on the resume. So we're helping them to get a job. Do I think in 5 years' time they'll be exclusively doing machine learning? Unlikely.
Right.
But will they have to sort of understand what others are doing? Will they have to decide whether this is an appropriate tool for an appropriate application? Sometimes it will be.
Yeah. So my employees hate me and the industry hates me for this. I make my employees write out the entire equation for the model.
Huh.
And it drives them nuts because I don't believe in the black box approach. I hear everyone say it's a black box, it's a black box. And like one of the most common methods now is XGBoost, which is just a massive decision tree where you're fitting off the residuals. And I often come back. So I worked in validation as well at the global bank. And it was really easy to fail every machine learning model because they'd build these huge trees. And then all I would have to do is go back and trim their trees up and say, here's a tree that's, 1/10 of the size of your original tree. And the accuracy, for example, if you're looking at that, is like, 0.95 on yours, mine's 0.94. So in complexity and understanding wise, we can trim a lot of this back into a very simple framework. But unfortunately, I think the machine learning realm, instead of, looking at how do we make robust models that actually work, they kind of leave that to, I built a model, I ran it on out of time data. So the back testing piece, it back tested great. So therefore it's a perfect model. And yet I think there's a lack of like, let's just simplify everything down into like a robust framework. And how do we test that? And so I make everyone do statistical testing on machine learning, and it drives my employees nuts. And then usually about 3 or 4 months of training, they start realizing we can draw meaningful conclusions from these without building overly complex models just for the sake of accuracy.
Yeah. I think it's an excellent idea, and you should probably create a commercial product that's, that can develop that further. Even I'm working on a study now with another academic on option pricing using machine learning.
Okay.
But rather than having a brute force kind of approach to it, we're taking a combined approach that takes insights from finance as well as some power of machine learning. And what we're trying to do is not to forecast. People want to forecast stock prices and stuff like this, which is kind of ridiculous, right? But I thought, why don't we do a project where we forecast hedge ratios,
Okay.
right? Because Black and Scholes, one of the problems with Black and Scholes is that if you just calculate the delta and use that to hedge, you would tend to do quite a lot of hedging.
Mm-hmm.
You would overhedge most of the time, and you might get to an outcome that's satisfactory to you, but it wouldn't be the most efficient hedge to do it. And one simple reason, if I put in simple terms, was to say that a lot of the calculations of delta don't compensate for the negative correlation between the underlying movement and the volatility movement. So you don't have a Vega adjusted delta.
Mm-hmm.
But now take this to the nth degree, right? And say, okay, now I can test for much richer relationships with that and see if I can come up with a better model for computing the hedge ratio and therefore a less costly program to do.
Okay.
So I think that's a place where I think we're making some headroads. We're too early to talk about the paper in specifics or publish anything, but it's looking promising that we'll be able to say something interesting about option pricing as a result of studying the application of machine learning to the determination of optimal hedge ratios.
Yeah, that's very cool. It's always great to see how people are actually using this for research purposes.
Yeah.
Because it goes back to that theory piece. You need to know the theory, and then being able to add all these tools and just helps you develop a better strategy for a business or for, an academic pursuit if you're looking at new ways to do things.
Yeah, and you have to be able to also not only know the theory, but also be prepared to abandon it.
Yeah.
When the situation calls for it.
Yeah, that's for quants. I think that's one of the hardest things. I worked in model validation for about 6 or 7 years, and that was the challenging piece of the political spectrum of it, of trying to teach students too, like you need the personal skills, like you were mentioning, because someone's going to spend 3 months or a year or something building this model, which is supposed to fix all your problems. And then as soon as you come in and poke holes on like, well, it's not going to work in practice because of these 3 or 4 things, there's always that tension of like, they have to argue to the point they have to stick to what they build. Because there's kind of that, I spent so much time on this, it has to be correct. There's no way I'm going to kind of abandon it and restart over.
Well, this is the benefit of being a consultant is they only call you in when something has gone terribly wrong.
Yeah.
And you end up in one of these situations, either the quants can't take it any further or there's a complete standstill where people are butting heads and they can't come to a solution. So they hire a consultant to break the impasse, right?
Right.
And oftentimes I didn't have to do anything, just sort of go through, what each side was thinking and point out, by asking questions what the limitations of that particular approach or assumptions were.
Yeah.
And it didn't matter if it's, two quants or a CEO and a CFO or a board member and a CEO. I mean, in many of these cases, it all boiled down to understanding these assumptions that went into their conclusions and why they're so hell bent on maintaining them.
Yeah, definitely.
Here's a good story. I went to a large energy company, which shall remain nameless. I was called in by the board of directors.
Okay.
To advise the board, right? Which is pretty rare, right? For a consultant. I said, well, I can't wait to see what's on their mind. And I get there and they have this problem that the traders have presented a trade to the board. And the trade is a gigantic trade. And the board said, look, we've seen the trade, we've seen net present value analysis. Net present value is negative, right? And so we're not going to authorize this trade.
Okay.
But the traders were insisting that the trade had to be done. What was the traders' point of view? Well, because, right, this is a constrained financial institution, this energy company. This is back at the wild days of energy trading firms. Think Enron,
Okay.
Do this trade, and it has negative net present value, but it hedges enough risk in your portfolio that you can go on and take another trade that adds even more value, then it makes sense,
Okay.
right? And telling you like this, it sounds so obvious, right?
Hmm.
But if you're in the middle of the fight where the board, right, is full of, septuagenarians, right, who learn that net present value is negative is a bad thing,
Yeah.
right? The new finance has to say, hey, maybe the net present value calculation is wrong, or maybe it's inappropriate. And here in this case, in particular, is wrongly applied. You could save NPV in this case, by saying holistically, by doing this trade, it's like a lost leader. I can get something that adds more value,
Yeah.
right? But if that thing is more ambiguous and hard to quantify, it's going to be hard to justify a negative NPV trade.
Yeah.
You know, so this is what I like my students to think that their first answer to a question should be, it depends.
Yeah. Yes. That's an excellent answer. I get students ask me questions all the time, and then I just go, well, it depends. I mean, what is the scenario? Yeah, there's all these details that come in that make the answer so different.
Yeah.
So for one final question here, what advice would you give a student who's looking to get into valuations more and wants to learn more about I guess option pricing, perhaps, or valuations of firms? What would you recommend they do?
Right. So I think, putting the question that way, I think it might put too much of an emphasis on options.
Okay.
As you know, options have dropped in popularity since we got our PhDs.
Yeah.
That's one thing. The market size is smaller. However, I think people don't appreciate how much options are embedded right in other things, and how all valuations should be informed by options. And there's another benchmark that we have to do valuations. So while I was making that side point, I kind of forgot the main point. So if you could refresh my memory.
Yeah. What materials would you have them study for that? I mean, is there
Yeah.
any good books, videos online? I know your presentation from the Peter Carr Memorial is great. I'll link that below as well for anyone who's interested in watching that.
Well, thank you for that. That'd be great. Dan Stefanica has written some books that I recommend from we have a boot camp. Although I do my own boot camp for our students, there's a set of books with solutions the students can work. And sometimes I feel he gets a little bit too theoretical, but most of the time he's right on spot in terms of preparing for an MSFE or similar degree. I think that's something that all students should do. Another thing that I've noticed is students come in, they tend to be particularly weak in linear algebra and statistics.
Yes, yes. I'm reviewing a linear algebra book right now for a book review. So I feel the same issues with that.
So all of a sudden you throw a t-test in front of them and they sort of freeze, like and I think part of that is because they come from very technical backgrounds, like physics students in physics aren't going to study statistics, right?
Mhm.
Because I guess everything's certain in that field. I just don't know.
Yeah, yeah.
But they don't learn statistics. They don't learn hypothesis testing. They don't learn time series. They might know some programming. They might know differential equations, that kind of stuff. They typically don't know like constrained optimization,
Mhm.
surprisingly, as well. So those three things: linear algebra, statistics, and mathematical programming. So that includes like linear programming, includes nonlinear programming, on optimization, constrained optimization generally. So I suggest they do that. We try to remedy that for students in their boot camp,
Okay.
by running them through mini courses and all this stuff. The other things I'm surprised by are people who come in and on the first day of class, they don't know what a bond is.
Yes. Yep.
Yeah.
We were explaining options in my class to students, and finance background and everything. I'm just reading all these books on options. What is a derivative? What is a bond? What is a stock? It's an interesting gap that a lot of students have from the math background.
So if someone tells me that they want to get a job in finance and then they come in and they don't know what a capital market is or a bond or an option at all, I
Mm-hmm.
have to be suspicious that they're just heard that some friend of theirs made a lot of money going into finance, and they wanted to repeat the experience.
Yes. Yes, this is my number one issue I have to combat online because people message me and they go, Dimitri, I'm not really good at math. I'm not really smart, but I heard you can make a lot of money. How do I get in?
Yeah,
Like
yeah,
you have to love it. Like reviewing textbooks over here. I've got a stack of them. And I'm just buying textbooks to read. I mean, this one is analysis of Financial Times series by Say. Because I'm buying textbooks to review programs and I just have interest in reading textbooks. And I think without that natural curiosity and interest in financial markets, it's
yeah.
really hard to build a career.
Yeah, how do you sustain the interest to do it? And you're going to hate yourself your whole life for having done this for the money. You know,
Yeah.
so I would say, and another thing is some people come in, they want to be traders.
Yes.
And
Yeah.
it's a similar discussion. Do you really want that? Do you really want to go and every day be glued to the machine? And maybe you're a quant oriented trader, but your whole mood depends on what happened that day in the market over which you had no control. And how happy are you going to be when you're fired in 3 years? Because of losses that were, reasonable for you to take those risks, but you nevertheless you lost anyway, and therefore you lost your job. Some traders can get back up and go work for somebody else, but most of them just sort of, disappear.
Yeah. I had a buddy of mine did that. He worked doing derivatives for mortgage products and he
Yeah,
just had to balance the book, like just keep it afloat. And he said he lost like 200,000 in a day. And he's like, it was devastating. And
right.
years of that was just too much. He left after I think about 3 years.
And people say, oh, yeah, it was duration neutral. And I say, really, how do you know? Well, we did the calculation. I said, well, your duration made several assumptions that were completely false.
Yeah.
If your whole job is to manage one gigantic mortgage portfolio. You probably should know how to design better risk measures, right? So that leads you to the last point, which is that even though most of our students come in because they want to be traders or quants, most of them will not say risk management is their top choice, but that's the number one job going out.
Yeah.
And it's not because of a failure of the program. First of all, it's because of demand in the profession for risk managers. But secondly, I think it's that people don't realize, that risk management is such a rich field.
Mm-hmm.
Because you have all the valuation stuff, the risk stuff, you have the regulation stuff, which some people like and some people don't like, fair enough. But the point is that you can get some very rich problems in risk management and a very satisfying career with more job stability. And maybe your trajectory isn't as high as it could be for the highest traders, but nevertheless, it's a great career choice.
Do you think programs are not teaching enough risk management? So I've been in risk for a decade almost now, and I love it because it's like I just go to work. I don't have the volatility of a trader. I'm just building models. But then I find a lot of the programs are really involved in teaching the financial side of it in the sense of like a trading buy side, because I guess that's where the money's been for the last, I don't know, 20, 30 years now, where it's like the risk side seems like boring, but I just enjoy it because of what you mentioned. It's career stability, it's low volatility. I show up every day, I build models, I go home, but it still includes all those interesting tools that we studied.
Yeah, that's right. And so it's a way to really, I think, round out your career by doing something in risk management as opposed to something narrow like trading. Now, of course, we'll cater to those students who want to do program trading.
Okay.
Right. So we'll sponsor trading competitions. We will provide resources at Bloomberg terminals, and so on. So that's supported, but we don't push our students in that direction
Okay.
necessarily. We tell them what the risks are. That as people who are fundamentally quants, they're not going to be hired to come in and become prop traders. It's just not going to happen. So I'm happy to see one or two of our students go and become traders. I don't have a problem with that. But if 25% of them suddenly want to be traders, I think we'd have a problem.
Okay. Do you think a lot of that comes from the way the programs look at the students and kind of bring them in? I just get concerned. I think many of the programs focus too heavily on the math. And it's like, okay, the candidate checked these 5 boxes and they have all these courses they need. But I don't think a lot of the programs are looking for students who have like a true deep interest in finance as a whole kind of field.
Yeah, I think that's fair, and you kind of cater to the strengths of your faculty.
Mm-hmm.
We try to keep a very diverse faculty. We have a very large adjunct group, industry with industry, obviously industry experience was in real time.
Yeah.
Covering, some are quants, some are risk managers, some are traders, some are, option, gurus. There's a whole range of careers available to these students, and I can't fault them for choosing what they want from the beginning, but it certainly bears investigation whether there's a better alternative out there for any of them.
Okay. Yeah, I'd agree with that. Well, David, it was great having you on the podcast.
Thank you. It's my first one I've done, so my pleasure. Thank you.